Welcome to the Explainer. Banking can feel like this incredibly complex black box, right? Well, today, we're going to crack it open. We're giving you the exact diagnostic toolkit that pros use to look right under the hood and see what's really going on. So, let's get started with our check. Look, we all get the basics. A bank takes your deposit, it lends it out to someone else, and it makes money on the difference. Simple enough. But how do you really know if it's a strong, healthy bank or one that's heading for trouble? That's the real question, and the answer is usually hiding in plain sight if you know where to look.
And here's the secret. You have to think like a doctor. A pro analyst doesn't just read the headlines. No way. They perform a full-on diagnostic health check. They have this precise set of tools to check a bank's vitals, to see its real strengths, and most importantly, to spot those hidden risks before they blow up. And today, that's exactly what we're going to walk through.
Okay, first stop on our checkup, the bank's core engine. You could even call it its heartbeat. We're talking about something called net interest margin, or NIM for short. This is, without a doubt, the foundation of how a bank actually makes its money.
So what is NIM? Well, in plain English, it's just the difference between the interest a bank earns from its loans and all its investments and the interest it has to pay out for all its deposits. The bigger that gap, the more profitable the bank's core business is. Honestly, you can think of it as the single most important vital sign for a bank's health.
All right, let's get real. Here's a lab result from fiscal year 24. ICICI Bank had a net interest margin of 3.53%. Now, is that good? Is it bad? On its own, this number just tells us, yeah, the bank is making a profit. But to get a real diagnosis, you can't just look at it in a vacuum. The real story begins when you compare this vital sign to its rivals.
And this is where we uncover the why. At a quick glance, you might think, wow, Federal Bank is doing great. It's earning 9.1% on its assets, the highest of the three. But then, look down a row. Its cost of funds is also the highest, by a lot. Now slide your eyes over to HDFC Bank. Look at that. Its cost of funds is just 4.1%. That is a huge advantage. And that's what gives it that superior gross NIM. Its profitability isn't just about earning more. It's about being incredibly efficient. So the burning question is, how does HDFC get its money so cheap?
Well, that question leads us straight to the fuel that powers this whole engine. It's what people in the industry call the ultimate competitive moat in banking, a strong CASA franchise. And CASA just stands for current accounts and savings accounts.
This chart right here, this is HDFC Bank's secret weapon. A whopping 44% of all its money comes from these low-cost CASA deposits. We're talking about the everyday checking and savings accounts that you and I use, and their power is in their price. Banks pay almost nothing in interest on these funds. It's the cheapest, most stable source of money a bank can possibly get. It's like having access to premium, low-cost fuel.
And just look at this difference. It's staggering. A term deposit, like a fixed deposit, that might cost the bank 6.2% in interest, but a CASA deposit, just 1.8% on average. That massive gap is everything. Building up a huge base of that cheap CASA money is what creates a sustainable, long-term advantage and a really healthy NIM.
Okay, so a bank has this powerful, efficient engine. That's great. But a fantastic engine doesn't do you any good if the bank is vulnerable to, let's say, a sudden heart attack. And in banking, that heart attack comes from bad loans. So, the next critical part of our diagnostic is checking the biggest risk of all, asset quality. To do this, analysts run a panel of tests to spot any red flags. You can think of it just like a cholesterol check. Gross. Non-performing assets, or NPAs, tell you the percentage of loans that have already gone bad. Then there's credit cost, which shows you the financial damage, how much profit is getting wiped out to cover those bad loans. And the really important one is the slippage rate. That's your early warning system. It shows you how quickly new loans are turning sour. Let me show you a real-world example. Back in FY 2021, Bandon Bank was in a full-blown crisis. Its gross NPAs shot up to a critical 10.1%. The bank was in serious trouble. But watch what happened next. Management acted fast and decisively. They aggressively set aside money for losses and started diversifying their loan portfolio. And the result? By FY 24, they brought that NPA level all the way down to a much healthier 3.2%. It just goes to show that even a severe health crisis can be managed if you apply the right treatment.
Okay, so we've checked the engine with NIM. We've looked at the fuel source with CASA. We've assessed the biggest risk with asset quality. Now it's time to put it all together. This is the final diagnosis, the pros all-in-one report card, return on equity, or ROE.
But here's the thing. A real pro never ever just takes a number like ROE at face value. They break it down. They deconstruct it using something called the DuPont formula.
It's a brilliant tool that splits ROE into its three key drivers: how efficient the bank is, how well it uses its assets, and how much risk or leverage it's taking. It doesn't just give you the final score, it tells you exactly how the bank got there.
This side-by-side diagnosis tells such a powerful story. You see that ICICI has a higher ROE, 16.8%. But the crucial question is always why? So we look at the breakdown. And what do you see? Their equity multiplier, which is a measure of risk, is almost identical. The entire reason for ICICI's outperformance comes down to one thing: its net profit margin. It is simply a more efficient, more profitable operation.
And this, right here, is the doctor's final note on the chart. This is the key insight. ICICI's better returns aren't coming from gambling with a ton of debt. They're coming from high-quality, sustainable, operational excellence. That is the kind of clean bill of health an investor loves to see. So, you know how to run the diagnosis. Now what do you do with that information? Well, this table is basically your playbook. When interest rates are rising, those banks with the strong, cheap CASA deposit bases, like HDFC and ICICI, tend to be the defensive winners. But when rates look like they're about to fall, the game can change, and the focus might shift to smaller banks who are poised for faster loan growth. So there you have it. We've looked at the engine, the fuel, the risks, and the final scorecard. You literally now have the same diagnostic framework that the professionals use. So the question for you isn't just about what company you'll analyze next, it's what are you going to see that everybody else is missing?